Now, Volkswagen is Germany's largest employer worldwide, and it may be on the verge of making huge cuts. Now, this follows recent reports from German car makers that show signs of trouble caused by slumping sales. Mercedes-Benz and BMW have lowered their outlook following lower than expected demand. VW denied a recent report that it was planning to lay off up to 30,000 employees. That's a quarter of its German workforce. But the company says it has to reduce its costs somehow. German Economy Minister Robert Habeck says he wants to help the car giant get through this rough patch without site closures. But Volkswagen is ultimately responsible for its own structure and viability. See if we can find out what's going on with Lars Halter from DW's business desk. Welcome, Lars. So what's at the root of these problems?
Hey, Phil. Well, to say it in one word, it's China. China used to be the strongest car market in the world, and specifically some of the German car makers were banking fully on China, and especially Volkswagen. They actually got about a third of their sales, a third of their revenue from China. So they had a full bet on China, and that went very well for a number of years. But over the last couple of years, China has weakened in terms of the car market. There we have, initially we had that real estate crisis, turned into a bigger economic crisis. So people are not spending that much. And even more important, there's domestic competition now. The Chinese have invested in their own car sector. So German car makers are doing a lot worse there.
Car making, though, is a key German industry. Is the government likely to get involved?
Yes, the government has already involved itself. Just today, just earlier this morning, Robert Habeck, the economic minister, who you also just referred to here, was at a Volkswagen plant in northern Germany, in the town of Emden. And he said he wants to get involved to a point where he hopes, and I want to have a statement here, he says he wants to avoid site closures, and he hopes that personnel policy measures would remain within the normal collective bargaining framework. So he says at the same time that obviously it's going to be up to Volkswagen what they do. There must be cost cuts of some sort. He has called for an auto summit, a car summit on Monday, and he says the government can obviously only set the framework. However, the framework, of course, can be highly important. For example, if the German government would decide to once again subsidize or intensify purchases of electric vehicles or so, that would be a big boon for the industry.
Is this just a German problem? Is it just a VW problem? Does it go wider?
It is definitely going wider because other car makers have shown weakness too, and much of it has to do with China. However, looking at the European sector, it is terrible enough with the China situation, but they do have another problem now too, because the car market here, especially for electric vehicles, is not doing very well. And now that is leading to an interesting conundrum here. Brussels has, of course, very strict emissions regulations. They set emission limits for the average car that a car maker sells. So that's interesting in terms of the product mix. Now, over the last couple of months, electric car sales have gone really down. The others, combustion, is still strong. So that kind of skews that whole thing. And now some of these car makers could be fined billions of euros because they not make it within those regulated limits. So they're asking Brussels now to loosen their regulation. Otherwise, it would not only be expensive, but they're saying there would be more job cuts if they lose billions. And that would also be money they could not invest in further research into, of course, alternative technologies.
OK, thank you for that, Lars. Lars Halter from DW Business.